Today is Tuesday, November 27th, and I'll do a brief update of the stock market this morning. We'll look at a few different time frames to gauge what's going on here. This first chart is an hourly time frame. This is the SPY ETF, and this shows a MACD indicator here. The MACD is overbought. There is no significant bearish divergence yet at this point, so we may see the market pull back briefly and then advance to new highs to form some divergence before seeing any type of significant correction of this upward move. These green lines indicate unfilled gap ups from below prices there. Gaps like that will tend to attract prices. They have a tendency to be filled before too long. I've seen stats that suggest the larger the gap, the quicker it is to fill. But without putting any specific numbers on that, it wouldn't be unreasonable to see, this large gap down after the election, and then these couple gap downs here filled in within the next several weeks. So I don't know what will be filled first. What I think might be a probable scenario is for the market to decline back and fill this gap down here, and then push up and fill this gap down up here before possibly a larger type of a correction of this initial leg up here. So this gap here is relatively small. I would say that's the least significant out of any of these lines drawn here, but those are just some things to watch. Certainly possible that the market does come down and fill this gap and give a nice buying opportunity for a short-term trade long. What we'd want to do is gauge how fast or aggressive any decline is that comes down to fill that gap to see whether it appears that this upwards move is stronger or the ensuing downwards move is stronger. Give us some idea of the logic or the power of the price movement in deciding whether we would want to take a long trade if the market does come down to this gap level here. This is an hourly chart of QQQ, and this shows a momentum indicator down here. And the momentum indicator, even while prices have been making significantly higher highs relative to the 19th, the momentum indicator down here is at a significantly lower high. So there's some pretty sharp divergence on the indicator, which, if this is a continuing downtrend, would be very significant. However, we've broken this downtrending line here, and we broke it with a gap, so that could be significant here. Still not unusual to see market pull back and test the broken trend line from the underside, or come down and fill that gap level before advancing, but that's what I think that this indicator shows, that the market could be due for at least a multi-day correction of this initial advance here off of the recent lows there. Now, I did want to point out this pattern in the tick indicator. This is a 30-minute chart of the Nasdaq tick index, so measuring upticks versus downticks, basically a measure of very short-term breadth in the market, and this has some moving averages on it, and what we can see is the tick got very, very high here at the end of last week. And here's the pattern I wanted to point out, is that QQQ made a higher high yesterday in price. So if we look at price, we can see that price did continue to higher highs yesterday. However, the tick indicator did not make a higher high, and it dropped somewhat sharply yesterday. That pattern has presaged corrections, or at least multi-day corrections, many times in the past. Another thing to look at is that SPY did not make a higher high, and the Dow did not make a higher high. The New York Stock Exchange did not make a higher high yesterday relative to Friday's high. So there's a slight non-confirmation between some of the broader or some of the blue chip indexes, and the tick is showing somewhat of a non-confirmation here in the Nasdaq as well. So again, that's just a short-term indicator, but that might suggest that we see some weakness this week prior to the market continuing its advance. This is a daily chart of the New York Stock Exchange, and I'm sure many people have noticed this that watch this, but the volume pattern has been not necessarily your textbook healthy rally pattern off of the recent low. We saw volume spike on November 16th. That was the day that Apple, that was this day here, where Apple had this big wide range hammer type of candlestick, undercut this prior base low that I had talked about several times in the past and then reversed. So that's the day we're looking at there. But since then, the initial 4 days off of the low on this rally here all occurred on successively lower volume. Now, we did have the Thanksgiving holiday there, and so typically the Wednesday and the Friday will have very low volume, so we probably have to forgive the market for that to some extent. But in any case, that is somewhat of a odd volume pattern as far as for a healthy market advance here. So that may indicate that we do see the market come down and fill some of these lower gaps before advancing. I did just want to point that out. I don't know how significant that is, especially considering there's some holiday time frame trade in there. This is the Russell 2000 ETF IWM showing the stochastics indicator. It's moved back above 50, which is kind of like a neutral line here after being below 50 for an extended period of time, basically off of the September highs. So this still has several days before it's going to be back into overbought territory. It does certainly look like it will be overbought at a lower high relative to the last overbought signal, so which occurred there in mid-September. Now we've seen this period where the stochastics has hugged the oversold line, and now it's coming back up. So this is going to set the market up with an overbought at a lower high type of a scenario, which would be similar to what happened here last July. Before that waterfall decline. So it could potentially be a very significant signal. That doesn't mean it has to roll over and move to new lows, but it's something to watch. And if the market does show any type of weakness or divergence and then starts to turn over, that could potentially offer some good signals for the short side. Another possibly significant point here is that this is the Nasdaq Composite, and this green line here shows an uptrend line connecting the October lows and the June lows from this year. And as the market tested those lows here just prior to the election, it found support, but then it broke that trend line with a gap down. And I've talked before in the blog how trendline breaks with significant gap downs are often significant, but it is very common for the market to experience a retest or a back test of the broken trend line before continuing its primary trend. So we may be seeing that here in the Nasdaq. And of significance also is that the 200-day moving average was right in that same area. So this trend line and the red line here, which is the 200-day moving average, were clustered together, and they were both broken with that gap down. So it would not be uncommon for after the 200-day moving average or that trend line is broken for the market to come up and test that moving average or that trend line before possibly continuing down. And the market is still underneath that trend line. One of the basic tenets of technical analysis is the old support. So we found support, support, support here, and that's broken, will become new resistance. So that could mean a couple of things. That could mean resistance followed by continuation of the downtrend, or that could mean even if the market continues relatively trending up, that the market does find some overhead type of resistance at the trend line, even if it continues an upward type of a trend there. So that's what to look for given the trend line breaks there. And some of the other indexes are in a similar scenario. If we look at the SPY ETF and look at that October to June trend line, the market is still below that trend line. So we have the unfilled gap overhead, we have the trend line overhead. So I do think that as the market comes up into this 143 level on SPY, the Bollinger Band is a little bit above that, around 144. We're going to have several overhead resistance type of areas with the Bollinger Band, the gap, and the trend line that may presage somewhat of a correction of this initial move at a minimum, even if the market is to continue its advance here. Now on a weekly time frame, this is the S&P 500, and this is a stochastics indicator, and we've seen a relatively typical correction in a move down here in the stochastics. It didn't quite get to oversold, but it is, as of this week, or as of last week, crossed up into a buy type of a signal. However, it's not very stable. The blue line is still slightly angled down, and we don't have any clear upward stable momentum at this point. The Bollinger Bands are squeezed relatively tight and narrow and horizontal here, so that would be at a similar configuration to how the market was here again last May, June, or June and July of 2011. If you look back at some prior instances here, somewhat similar to how it was at the November 2007 low as well, as it came off of that bull market high. So we may be looking at just a couple week correction here followed by a larger decline. We'll have to see, but that Bollinger Band configuration and stochastics configuration has occurred at some of those prior areas in a similar fashion there. The weekly MACD on the S&P 500 is still in a sell signal with an advance last week. It is starting to angle up. We did see a similar thing happen after the 2007 high, so we saw this sharp bearish divergence in the MACD into the October 2007 high. We had a few week initial decline, and then there was a rally for a couple weeks here into early December of 2007, and we did see the MACD kind of tick up for a couple weeks there before undergoing somewhat of a waterfall decline into January of 2008. So the technical setup and even the seasonal setup is somewhat similar to how it was there at 2007. So we'll have to see what happens here. This red trend line here on the S&P 500 is something I've pointed out over the last couple months, and that's the trend line connecting the bear market lows, so March 2009 to this October 2011 low. The market has not broken that yet, and that would be probably a poor indication if the market does come down and break that low, probably a poor indication for the continuation of the bull market. But at this point, that's really the main base trend line for the entire bull market. So as long as the market stays above there, I think we have to give it credit for the ability to continue to advance, but I would be watching that trend line there again for a possible break of the trend line and then retest of the trend line. Now another point of note is that the Commitment of Traders report, which measures the large futures contracts being traded in the market, showed extreme buying at the August 2011 lows after that waterfall decline, so created somewhat of a smart money support level here, or buying level here. There was a significant buying that occurred into this June low in 2012, and right now we're seeing somewhat of a mixed bag with the Dow and the Nasdaq showing very significant buying in the by the smart money in those contracts, but the S&P not really showing that. So it has shown a somewhat typical level of buying for at least a corrective low in the market. So I think we need to respect that, but it is to some extent out of character in that the most heavily traded contract, which is the S&P 500, has not really seen that type of smart money buying come in that it has seen at some of these other corrective lows. So a little bit of an odd setup there as far as that goes, and certainly the market was on a long-term basis very speculatively overbought at these recent highs. And what I talked about here in September is that given the difference or the spread between the smart money commercial traders in the COT versus the dumb money traders, either the small traders or the large speculators, that the past times the spread had been that large, we saw approximately an 8% correction minimum each time. And that's basically what we saw this time too, is about an 8% correction in the market. So that was very typical, fit in line with expectations there. Again, at this point, if we see the market put in a little advance here and then break to new corrective lows, I think that would be a major failure for prices given the long-term setup here. So that's something to watch for, is just this November low, and kind of draw that on your chart and understand that if the market breaks that low, that's possibly a continuation point for a larger decline, and that would likely coincide with the break of this red trend line, because this trend line is rising. So if we get the market advancing for a few weeks and then decline, by the time this market gets back down to that trend line, even 4 weeks from now, that trend line would be already at this November low. So on a weekly time frame, that's what to look for there. So that's all I really wanted to cover in this update. I think we're likely to see some choppy short-term action and somewhat unclear on the long-term direction of the market here, as we've had some divergence and initial weakness on a longer term basis, but the market is finding some support and holding the long-term trend lines there. So that's my take on it. Have a great day. Probably update again later this week or this weekend.